This is the third part of the instructional video for Chapter 1. The financial statements are prepared in accordance with Generally Accepted Accounting Principles, or GAAP. The objectives of financial accounting are to provide information that is useful to investors and creditors and any other users in making rational decisions. Helps investors, creditors, and other users assess the amounts, timing, and uncertainty of prospective cash receipts from dividends or interest, and the proceeds from the sale, redemption, or maturity of securities or loans. Clearly depicts the economic resources of an enterprise. And the historical principle is heavily used, so we would like to define it and know it. The historical cost principles requires companies to record assets and services at their acquisition cost. This is the amount paid at the time of the transaction. The principle is used because of its reliability. An example would be if a company bought a piece of land in 1950 for $20,000, this land will stay on the books of the company for its acquisition cost, or $20,000, regardless if the market value is $20 million at the time. When you're analyzing financial performance, keep in mind the challenges the accounting profession has to overcome. Challenges for the financial accounting professions include non-financial measurements. Financial reports do not include some measures that are hard to express in dollars and cents, such as customer satisfaction, backlog, reject rates, etc. Forward-looking information. Financial reports fail to provide information about the future in a definite manner. Soft assets. Financial reports fail to provide information on soft assets such as market dominance, know-how, branding, knowledgeable and dedicated employees, etc. Timeliness. Real-time financial statement information is not available. There is a time lag of 1 to 3 months before we are able to see verified or audited financial data. The next learning objective discusses the International Financial Reporting Standards. They're also known as IGAAP. They were developed by the International Accounting Standards Board. It is a London-based independent standard-setting organization. IGAAP was adopted by the European Union in 2005. It is currently used in over 115 countries. The US is not one of them. There are many similarities between GAAP and IGAAP, but there are also some major areas of disparity. You can study them in depth in the intermediate accounting courses offered by Cincinnati State. Ratio analysis is used to evaluate various aspects of a company's operating and financial performance, such as its efficiency, liquidity, profitability, and solvency. The trend of these ratios over time is studied to check whether they're improving or deteriorating. We will discuss several ratios in this chapter. Debt ratio is the first one and is computed as total liabilities are divided by total assets. This ratio reveals the portion of assets financed by debt. The higher the ratio, the greater the debt, the greater the risk to deal with this company. Asset turnover ratio is computed as revenues are divided by total assets. This ratio measures how efficiently the company uses its assets to generate revenue. The higher the ratio, the more efficiently the company is using its assets. Please keep in mind the nature of the industry. Some industries are very much asset intense. They cannot operate without them. Other industries do not require as much assets. Think of Delta Airline and a CPA company. Very heavy asset intense versus not at all. Next ratio, return on sales, is computed as net income is divided by sales. This ratio measures the profitability of each dollar of revenue. The greater the ratio, the better the profitability. More of the sales dollars end up as profits. Return on assets is computed as net income is divided by total assets. This ratio reveals how efficiently assets are used to generate profit, or net income. The greater the ratio, the more efficiently the company is using its assets to generate profits. Again, be mindful if you are comparing companies from different industries. Trend analysis compares a base year to more recent years. Let's look at Nike's trend analysis. The base year here is 2008. The following 3 years are compared to 2008 through the indexes shown to the right of the year's dollar value. The revenue for 2009 increased by 3%, or the difference of the indexes, 103 minus 100, but expenses increased by 6%, which led to lower profits. 2009 profits were 21% lower compared to 2008. In 2011, revenues and expenses increased 12% from 2008, and profits increased by 13%. This type of analysis can quickly show changes and trends, which can be very helpful with new management, changing economic conditions, etc. Common-sized income statement expresses all line items in the statement as a percentage of sales. You can see that in 2009, Nike's total expenses were 92% of sales, which led to a lower percentage of profits. You can use this type of analysis to compare a number of periods as well as companies of different size. Common-size balance sheet expresses all line items in the statement as a percentage of total assets. You can see that in 2010, Nike's total liabilities were 32% of the company's assets. That led to a higher percentage of shareholders' equity. We can use this type of analysis to compare a number of periods as well as companies of a different size. By the end of the course, you should be able to read most companies' annual reports and form an opinion about the company's financial performance. And Chapter 1 provides an overview of the material covered in this course. We will study most of those in greater depth later. Thank you for watching.